Hi, everyone. My name is Gemma Yates. I am Investor Engagement Lead at ACCR. I'll be hosting today's webinar. Before we kick off, I would like to start by acknowledging the Gadigal people of the Eora Nation, who are the traditional custodians of the land that I'm dialing in from today. I'd like to pay my respects to elders, both past and present. A few housekeeping notes. Just so everyone is aware, this webinar is being recorded. There will be the opportunity for Q&A at the end of the presentation. So just pop your questions into the little Q&A box at the bottom of your screen, and we should get to it in plenty of time. I think at this stage, the presentation will take between 30 and 40 minutes. So joining me on the panel today is Sam Hall. Sam is ACCR's Policy Engagement Analyst and was the lead author of this excellent benchmarking for change report. So Sam will be presenting today, and without further ado, I'll hand over to Sam.
Thanks very much, Gemma, and thanks everybody for joining us this morning. You'll have to excuse me. I have come down with a little bit of a cold, so coughing and sneezing or whatnot, I'll try to keep to a minimum. Yeah, very glad to be presenting this recent research to you this morning. Benchmarking for Change is the title, and as the title suggests, essentially we've gone and looked at some leading Australian ASX listed companies in terms of how they perform on benchmarks for both their political spending as well as their climate lobbying. So that is the key question. What is the disclosure and the governance? How do leading ASX companies manage how they spend politically and how they lobby on climate and energy transition matters? This presentation will sort of mirror the structure of the report itself, in starting by looking at the political spending piece, and the way that we do that, and I'll speak a little bit more in detail about this, is looking at these leading ASX companies and benchmarking them to an existing very authoritative index out of the US that looks at the S&P 500. In the second section, we look at a subset of energy and resources companies amongst that group of leading ASX companies. These are also companies that we regularly engage with at ACCR. And in this section, we focus on the climate lobbying piece. The climate lobbying and political spending, of course, do have some overlap, but we zero in on this particular area in that section. And then, throughout those two areas, I will obviously talk about tools and ways that investors can approach stewardship and engagement on these issues, but I will wrap up at the end just to sort of bring some of those forth and highlight them to you. So diving into the first section and looking at the political spending angle of things. So a little word on methodology and approach of this research first. What we did was we saw a lot of value in comparing Australian companies to the sort of leading global benchmark on political spending, disclosure, and governance, and that's called the CPA-Zicklin Index. It's been running since around 2004, but has been benchmarking the whole S&P 500 since 2015. Has actually started on the broader Russell 1000 last year and has continued that this year. It is a benchmark based on questions that they call indicators, and they essentially look at how companies do on the disclosure and the governance, as well as the sort of policy commitments relating to political spending. That is to say, this index isn't a value judgment on where the spending is going, what donations are made to which causes or political parties and so forth. It's really just looking at the transparency and accountability infrastructure or processes that companies have in place, and then assessing those on on a 0 to 100 scale, and it's not relative, it's not sort of scaled or put on a curve in any sort of extra way. It's just pure performance out of 100. And so partners of ours commissioned these assessments to be performed by the proxy advisor ISS ESG, the ESG arm of that proxy advisor, and they conducted the assessments sort of independent of us. So we really wanted to mirror that benchmarking and assessment process that's been established in the States and just have sort of a standard process that was being done by the third party. The way that we selected those was based, the ASX companies was based on market cap and sort of timing that synced up with CPA-Zicklin Index's selection of S&P 500 companies as well. There's more detail on that selection in the report. The number one takeaway, essentially, that we got from the analysis of the Australian companies is that leading ASX companies, these 50 companies, are quite a long way behind the US S&P 500 on transparency and governance of their political expenditure. So as you can see from the chart, the performance is around a third of US performance in 2022 and actually quite a ways behind still US performance in 2015. Having said that, the engagements obviously in the US have a longer history and have gone back to 2004. So it's not to say that the US started from zero in 2015 and we're already sort of behind that. There is a longer history, but nevertheless, there is obviously quite a long road ahead for Australian companies to lift performance on this area of disclosure and governance. We're obviously also very interested in understanding why this performance was relatively underwhelming. We had the hypothesis that potentially there might be some very high performing companies that are dragged down by a majority of lower performing companies, for example. But when we dug into the data and looked at the distribution of performance across equal 20% tiers here, we see that really there were no Australian companies that scored well. None of them scored even as high as the average of the US companies. There's only one in that third tier from the 40 to 60% performance level. And as you can see, the majority were performing in the lower tiers, whereas in the US, you have a very different story. Actually, the majority, the mainstream now is performing in those top tiers, in the first and second tiers of performance. Likewise, we were interested in understanding whether poor performance was driven by idiosyncrasies of the market here, where, say, Australian companies were much better at making commitments and policy, but poor at allocating governance responsibilities, for example, or some quirk that meant that performance was dragged down by a certain area of disclosure and governance. And we did not see that. We see fairly consistent underperformance across all of the categories relative to the US. Interestingly, there is a very similar pattern, though, where, as you might expect, policies or commitments that companies make are usually, companies are more willing to do these, and then oversight and disclosure lag a little bit behind that. Which is understandable because there's a little bit more work and more burden and more exposure in doing that. And similarly, because of that, you see somewhat of a gap between the commitments made and then the action taken to sort of ensure that those commitments are being followed through from a governance and action and disclosure perspective. And that's much like the US. So we see similar behavior essentially here in Australia, just at a lower level. Now, that is relatively sobering news when we look at the underperformance of those leading ASX companies. But the good news is that the US has improved over time, but also that company size really doesn't limit performance. So you might wonder if the size of a company and its resources really stops a smaller company getting around to these sorts of matters, making sure policy and governance are set up in the right way. And what we found is essentially market capitalization is quite a weak predictor of performance on the CPA-Zicklin Index. So you see some of the smallest companies regularly outperform, or at least do as well as the very largest companies in their peer groups. And that goes for both Australia and the US. US is more indicative. Obviously, you have that full range of performance. And here in the chart, we've compared similar sized, so companies in the same USD market capitalization ranges as the Australian companies we looked at. And you can see that, there's about an 8.5% prediction relationship between market cap and performance is relatively weak, and that there's really quite a lot of companies performing at the highest levels that are quite small relative to their peers on that index. As I alluded to, performance has improved over time in the US, and this is not an overnight thing, but it's a very encouraging trend and a very steady trend that you can see over time. So since the US CPA-Zicklin Index has been running on the S&P 500 companies since 2015, you see very steady and clear improvement across the companies that are repeatedly in that index. So 350 companies that have been in the index every year. And the chart shows quite starkly, as you can see, that the proportion of companies performing at the top level in 2015 was really quite a small minority. And now companies that perform in that top tier are really the largest group. And then if you take the top and the second tier, they are the majority. It is very mainstream. And then tipping on its head now, those underperforming companies are really the small minority within the index. And so this has been quite a stark change, and it just shows that change is quite feasible, and that there is quite a lot of potential for the Australian market to move in a similar way. Now, many investors will rightly ask themselves who to focus on when pursuing engagement on political spending. Can leaders or laggards already be identified? And then we sort of spend our time working on those with a lot of leadership potential. Unfortunately, the US experience shows that it's quite hard to predict those leaders and laggards. They come, high performers can be across all industries, which is great because it doesn't rule out industries. Obviously, size is also not an issue. And what we see is essentially that broad-based index-wide engagement has seen a general lift in performance across that index, and then also some leaders and laggards emerge out of that. So in this chart, you can see actually, almost surprisingly, in the US, the companies that perform poorly in those bottom and fourth tiers, they actually perform even worse than the Australian companies average in those tiers. And so what that tells you is that companies that are performing poorly in a more mature market in the US have essentially decided that they will perform poorly and are laggards by intention, whereas the Australian market at the moment, due to its immature and sort of the Australian market at the moment, because the level of engagement and sort of thematization of this topic hasn't been so extensive yet. It's less ordered and intentional, that bottom performance. Prior to this research, which looked at performance in 2022, we had done some pilot assessments of Australian companies in 2016. We looked at 20 companies on the CPA-Zicklin Index in 2016, and now we're able to compare the performance from between then and now. And what we see amongst those 20 companies is firstly that the majority of them, 14 out of 20, have improved, and that improvement across the 20 companies is 4.6% on average. And so this indicates to us that despite not very much direct engagement by investors, shareholders on political spending specifically, ESG matters, that general pressure from the market, as well as elsewhere, regulators and consumers have brought some small lift to disclosure and governance of political spending for Australian companies. It's just that lift is not happening fast enough, as you've seen already, that the Australian performance is far behind the US. But very encouragingly, what we also find is that investor engagement is really the key to improving governance of political spending. I think this is probably one of the most important takeaways from the research. And basically what we see from US performance over time is that even companies who are engaged by investors on political spending matters, but don't come to an agreement with investors on how they might do that, end up performing about 65% better than companies that are not engaged at all. That's, to say nothing of the companies that end up coming to agreement, who perform almost twice as well as companies that are not engaged. So that obviously paints a very strong picture, and is a great argument for engaging and engaging over time and on a broad base, because even if engagement doesn't result in agreement immediately, it does bring awareness and general lift and improved performance on this matter. For context, in Australia, there's actually never been a shareholder resolution filed specifically on direct political spending in this country, whereas in the US, it is quite a mainstream and common thing to do. Not to say that the only way, of course, of engaging is through formal shareholder resolutions. Many of these engagements that have happened and happened successfully in the US are private engagements that either involve shareholder resolutions that are withdrawn or never even reach that stage. And then a little bit of insight into sort of how to engage and where to start on political spending. What we see across categories, and you will see several charts like this in the report, and this is just an example of one area, is that companies do pursue easier actions or low-hanging fruit first, and then they become bolder over time. So we're definitely not advocating for everybody changing overnight. There are some companies that are really ambitious and willing to improve, and we've seen improvements of up to 97 percentage points within a year. But most companies do improve gradually over time, and they improve in a steady way. They generally don't backtrack once they've started to put these things in place, which makes investors' lives easier as well. And as you can see from this chart, they're going to start with easier measures at the lower levels of responsibility and the lower sort of levels of onus and less onerous actions in terms of, first applying lower level oversights and then escalating it to higher levels of seniority, for example. So I've spoken a lot about political spending specifically, and now I'll move into climate lobbying, where we focus, as you'd expect, ACCR too, on energy and resources companies, given their strong influence and importance to the energy transition. I'm sure everybody is quite aware, but it's important to keep in mind that energy and resources companies are major political donors. And so this is a great reason to focus engagement on them when you're thinking about political spending as well as climate lobbying. This data here is from official Australian Electoral Commission disclosures over the last 10 years, from financial year 2013 to 22. And what we see is energy and resources companies are spending, at least in their declared expenditures, around 15% of the total. And that proportion may very likely be quite a lot higher if we accounted for undeclared spending, as well as donations channeled through political fundraising bodies and lobbying firms, which I've omitted here, as well as some of the outlier donors like Clive Palmer that also bring that average down. So this is sort of tip of the iceberg insight into their level of spending. And of course, that spending also is there to influence and does indeed have influence. As many of you will be quite aware, the energy and resources sector has been successful in advocating against some positive climate policy in the past in Australia, most notably in 2014 and 15. Mining taxes and the emissions trading scheme and some other positive climate policy was actually stalled or thwarted due to quite concerted political spending campaigns that included other forms of political spending as well, advertising and so forth. You can see that in the chart around 2014 and 15, where the proportion that energy and resources companies spending jumps up quite a lot. So returning firstly to political spending before I move to climate lobbying, and just focusing on these 5 energy and resources companies that we focus on. So Rio Tinto and BHP, the diversified miners, Woodside and Santos in the oil and gas space, and then Origin as Jen Taylor. We see obviously that they're all performing worse than the US average on the CPA-Zicklin Index for political spending, and that here the Jen Taylor and the 2 oil and gas companies are also performing somewhat worse than the diversified miners, perhaps as a result of general positioning and sort of a role that they see within sort of ESG conversations more generally. What we don't see is much of a pattern across the categories of disclosure policy and oversight. It's not clear that they're all excelling in one area or another, and that once again sort of betrays the relatively low engagement and sort of immaturity when it comes to political spending by some fairly high spenders in this country. So as a reminder, these companies also do not have clearly Paris-aligned political engagement track records. The think tank Influence Map regularly assesses companies on their performance of climate policy engagement, both based on their direct engagement as well as through industry associations. And as you can see here, these 5 companies will have either mixed or misaligned policy engagement with the Paris Agreement. So anything in that C range is sort of mixed, and D and below indicates negative engagement. That, in our minds, just increases the importance of engaging these companies on both their political spending and their climate lobbying. So to understand climate lobbying specifically a little bit better, we turned to another benchmark called the Global Standard on Responsible Climate Lobbying that was released in 2022 by a group of investors across the world, quite a lot of investors in Europe, and they are they came together in consultation with various companies and other investors to really develop this standard that was based on the many different standards that were out there issued by PRI or other organizations that were concerned with climate lobbying, to build a best practice and easily workable checklist and standard that both companies and investors can work with to check on, but also drive engagement and improvement of climate lobbying. Now, this global standard has not been formally scored, and there isn't a scoring methodology like the CPA-Zicklin Index. What we have done is perform some pilot studies based on a scoring methodology that mirrors the CPA-Zicklin Index's approach in many respects. And we applied these pilots to those 5 energy and resources companies. And the results, I think, are relatively intuitive, that you see generally fairly low performance on average in those black bars, the range being only from 39% up to 75%, and the average being around 56% on average. And then the oil and gas players performing quite a lot lower, and then your diversified miners performing a bit better, and the gentailer at the top. What we see consistently, though, across all of those levels of performance is a notable gap between policies and commitment in the purple bar, and then what is actually done in terms of governance, and then the disclosures, and particularly those disclosures in green. You see quite a gap between the purple and the green. And so this sort of wraps things up, I suppose, in terms of the findings of our research. And as I mentioned at the top, I have already noted various ways that we think it would be good to pursue engagement, but I will revisit those briefly now in summary. So we believe that investors can use both the CPA-Zicklin Index and the Global Standard on Responsible Climate Lobbying as benchmarks to measure and improve the transparency and accountability of companies on these two topics, on the political spending and the climate lobbying. It's really a powerful tool because they serve as benchmarks, they're scoreable, and you can compare over time and really track these things. We find that it can be difficult to wade through all of the reporting and sort of get a view on lobbying disclosures and governance, for example, over time. And so using benchmarks and sort of scoreable standards like this is a good way to track that performance over time, as well as to compare to peers, let's say, in a similar industry or across an index. A really valuable element of both of these benchmarking tools is that they're not prescriptive to management and boards as to where they should be spending or how they should be lobbying, beyond, that the lobbying should be Paris aligned, which I think most investors and companies are very keen and eager to make clear that they and demonstrate that ambition to align with Paris. And then, of course, that shareholder engagement is critical to driving change. We would really like to emphasize that CPA-Zicklin has only worked because of investor engagement. And so given that really strong track record, we think there is potential to replicate that in Australia, but also to also replicate that for the global standard, given how similar the global standard is in its construction, and how it has similar categories and that sort of benchmark feature. And so we think applying the global standard could potentially see quite similar positive results in engagement to the CPA-Zicklin Index. From ACCR's perspective, energy and resources companies are the priority companies to target, not least because they're large political spenders and they have significant influence over policy, but on balance, they're not aligned with a orderly transition and Paris Agreement goals in those climate policy engagements. And also there's quite that gap between what they say they will do in terms of disclosure and governance, as well as climate lobbying, and then what they're actually doing when it comes to disclosure and the governance of that. We don't necessarily think that exposes companies to immediate greenwashing risk, but we do think that groundswell of pressure on greenwashing, as well as regulator interest in greenwashing enforcement, is something that should be considered in this context, as it will probably rise and become more pointed as the years go on. And yeah, I've already said that the global standard is also a very systematic tool that you can use, and it's very practical and pragmatic, essentially, to apply to the companies that you engage with, to not just identify those areas of improvement, but also chart a path forward for ambition. And then finally, the way that one can use these tools to engage companies is is really best done in a persistent and sort of broad-based manner. We're not saying that you need to overburden yourself by engaging too many companies at once, but I think steady rollout, both in scope across companies that you're interested in, as well as over time, and sort of keeping that pressure on, has shown to result in quite clear and positive change over time. The low-hanging fruit approach is the one that we would recommend, to work with companies and help them identify, using the questions and indicators on both these indexes, to chart that path forward and say, this year these things are very feasible and doable, and in coming years we think we can get to this level of performance. That's not to rule out the potential for really overnight and quite stunning improvements over time, and so definitely encourage and be open to that. But in general, the performance has been gradual and over time. So we would encourage that sort of concerted and broad-based engagement on both scores. That brings me to a conclusion. Very happy to take any questions that you might have, and of course, return to slides to address specifics if need be. But yeah, thank you very much for your time.
Thanks, Sam. If there are any questions, please add them into the little Q&A box at the bottom of your screen. Thanks, Jeff. So Qantas arguably has most recently demonstrated that companies should have greater clarity on their political activities, especially donations. However, since companies are not obligated to disclose their political donations in their filings, how can shareholders find up-to-date information on topics like political donations? Also, how would ACCR view, for example, the support given to the voice by many companies when it comes to political activities as a form of lobbying?
Yeah, so on the first question about disclosure, this is very much what the CPA-Zicklin Index is all about. The issue is that the regulations don't require that disclosure beyond certain minimum thresholds, and those are, as you know, quite limited in scope, but also time delayed, and they don't really enable timely engagement on these matters, or a sort of level of granularity that would be desirable. And so what we've seen out of the US through the use of the CPA-Zicklin Index is that voluntary disclosures are very possible when driven by investor engagement, and there's quite a lot of motivation, usually from a reputation and sort of peer-to-peer comparison perspective, that companies are quite happy to disclose more information about who they're spending and how they're spending and why, if they're engaged by investors as well as the broader public. And so you may see some companies unwilling to do that, but given there has been fairly limited specific engagement on these matters, I think it's quite early days, and there's a lot of potential there for companies like Qantas, but across the board really, to tackle these issues. So yeah, my answer in short would be to encourage that engagement and just ask for it, and spell out why you as an investor see that as something that would be valuable to reputation, accountability, and sort of just transparency, such that stakeholders can kind of rest assured that there are no sort of hidden dangers and whatnot that may crop up in future. In terms of the voice, let me return to the specific question. How do we view support given to the voice by many companies when it comes to political activities? Look, we don't, I think, take a position on whether or not companies should have spent money on the voice, or indeed any other political or electoral matters. Given our focus on climate change, we obviously care about policy engagement around the energy transition and climate change specifically. We support corporations' right to spend, as is sort of spend politically as is due to them under the Corporations Act and so forth. And I would emphasize that the CPA-Zicklin Index too is really not a attempt to value judge these things either. That's really up to broader stakeholders, the folks that have their money with the companies. And this is the key thing about transparency and accountability. If we don't have more transparency into these matters, then it's very hard for investors and other stakeholders to really engage with. So, our position would be transparency is the number one thing first before we can really have a fair engagement across the board and understand, who is spending where, and then we can compare. And as you saw, the Australian performance across the board is quite low, and so that means low transparency and low insight, and means that investors are not equipped or able to engage as well as they could on matters like that, even if they wish to.
Thanks, Sam. Second question. Missing industry associations in the energy and resource sector. Do the sampled companies engage outside industry associations on political and climate lobbying, or are industry associations playing a minimal role in lobbying on behalf of members?
The sample companies definitely engage both directly and indirectly. The direct engagements are fairly difficult to track because they're often behind closed doors. So the proportionality or the proportion of how much their engagement is happening in those closed door settings is obviously always an unknown quantum. We do see on average more negative engagement when it comes to climate policy and the energy transition when it is conducted indirectly and through industry associations. So we do see industry associations as a particularly problematic area often, not always, and industry associations obviously do have an important role to play in the conversation and in standard setting and private market ordering and so forth. But there is somewhat of a phenomenon, as it were, quite consistently that companies outsource some of the more negative lobbying to industry associations because it's not attributable to them individually, and there is always some area of plausible deniability that this is a broad membership-based organization. We can't dictate the terms on behalf of all association members. Having said that, we don't think that is usually a legitimate excuse. Many of the companies do have quite a strong voice inside the industry associations and essentially direct them in much of their advocacy, and especially if they're on the board or are high fee paying members, they do have quite a lot of control over the actions of industry associations. So, to sum up, I think both direct and indirect are quite important here, and often the indirect advocacy through industry associations is a little bit more negative and something where pressure can be applied to make sure that the governance is directing those associations to be more positive, but also in line with the company's own ambitions and commitments.
And I'd just add to that ACCR does monitor industry associations for the companies that we cover quite closely. Okay, so if we don't have any other questions, Sam's email is at the bottom of the screen at the moment. If you do digest the information and would like to follow up with either of us, then please reach out. We are very happy to discuss anything or answer any other questions as they arise. But 11:42, well done, Sam. I think we can give everyone an early mark. So thank you, everyone, and have a lovely day.